All right,
Well,
Nora.
good afternoon, everyone. Hello.
All right, so I'll just cue this up that this is the recording that we are doing for our tax presentation. We gave the presentation last week and had a little issue with the recording, so Nora and I are re-recording for everyone's enjoyment. It's going to be sent out to all participants from last week and also posted to the GenCrest website and put on our YouTube channel. So we're excited to have you, and I'll go ahead and pass it over to Nora to get us started.
Thank you, Ashley. Well, we are so glad you're here with us remotely through this presentation. You're with us for our annual year-end tax strategies presentation. Today, we'll be discussing the onset of the One Big Beautiful Bill Act, which was enacted on July 4th, 2025, after much fanfare and debate. Here, we'll refer to as OB3, and we will be looking at how it impacts your finances today, tomorrow, and beyond. The scope of the material will be broad rather than too deep because it is a lot of info. In addition to OB3, we'll go through 2025 tax updates to be aware of and tax saving strategies to consider for the 2025 tax year. Remember, it's not too late. We'll also sprinkle in strategies for the next couple of years. And just a quick note before we proceed, you will see at the bottom of this slide the legal disclosures regarding how GenCrest offers securities and advisory services. Now, before we jump into the material, I would like to introduce myself and then pass it over to Ashley Madden, who is the Director of Financial Planning Services for GenCrest. Ashley also works directly with clients on financial planning and investment management and specializes in business owner exit planning strategies. So I am the senior tax accountant here at GenCrest and have been in this role for a little over a year. While my degree is in accounting, my professional background is a bit more varied with managing the daily operations of an investor relations team at a large real estate company, stepping in as a controller at a large nonprofit, and then both public and industry accounting. Now, for those that were available for the presentation last week, I was going to take my third enrolled agent exam yesterday, and I did, and I passed. So, what that means,
Yay!
what that means, and for those who don't know, I am currently working towards my enrolled agent designation, and I am almost there. So now that all three exams have been passed, then I'm now ready to move forward with the enrollment process. And it's looking as though I'll have my official EA letters in early 2026. So now passing over to Ashley, who can share more about herself and GenCrest.
All right, so thank you, Nora, and we are all so proud of you here on the team, and I know our clients are as well. It's a huge achievement to get this enrolled agent exam work done. So myself, I am the Director of Financial Planning here at GenCrest Capital Partners. I have been with GenCrest, and we were formerly known as Hutchinson Family Offices for many years. But I've been here for a little over 7 years, and time really flies when you're having fun, I have to say. I joined the firm with both a background in tax planning and tax return preparation, as well as financial planning and investment management. My role here was much more focused on the tax services that we offer, but over time, I've continued to increase more and more on the financial and investment side, working directly with clients on that. And so we had Nora join the team last year. And I continue to provide guidance and oversight to our tax planning and tax return services, but Nora is really handling the day-to-day part of tax work that we do here. And as we say here at GenCrest, teamwork makes the dream work. And I am really so proud of Nora. And I also want to give her a big thank you for all that she did to put these slides together. They are absolutely beautiful. It's a lot of work. So thank you, Nora, for that. So a little bit about GenCrest and who we are as a firm, the kind of clients that we serve. Many of you that were on the call last week and hopefully hearing this recording moving forward may be familiar with GenCrest. But just as a recap, we are a financial planning and investment firm. Our tagline here on this slide, helping build wealth for life, peace of mind for generations. So we have a focus on family office services customized to our high net worth clients and their families, private wealth strategies that includes our investment management, including investment options like structured notes, alternatives, and an active stock portfolio management strategy. We have our tax planning. Certainly, a huge part of what we do here is to incorporate in tax planning into all the work that we do. The business exit planning and also divorce consulting. So the name that we rebranded last year is GenCrest, and so our name really does reflect our focus and dedication to high net worth families. Of the Gen Crest, Gen is generational, and then Crest is from a family crest. So Nora, you gonna go ahead and talk us through the agenda now?
Hmm? Yeah, thank you, Ashley. All right, so looking at our agenda for today's discussion, we have three main parts with the goal. Well, it was to leave questions last week, and so we were able to do that, which is great. But here Ashley will wrap it up right at the end. So we're going to jump into certain impactful OB3 changes, and then we'll share an overview of the 2025 tax year. And then the final part will focus on tax saving strategies for today. That's the 2025 tax year. Tomorrow, which is 2026 and beyond. And just please keep in mind that this presentation in itself is designed to be general information. It is not specific tax advice. So let's jump in.
All right. So the first thing that we wanted to talk about, Nora and I were noticing as we were preparing for this and getting up to speed on all the really big, lots of changes with OB3 that we're all looking at. Again, some of the changes starting in 25, some of them starting in 26, some of them beyond that. But one thing that we noticed was that there was a lot of reference to magi. And for those of you who are familiar with the author O. Henry, this is very different than Gift of the Magi. But it is an important thing for us to go over to understand the thresholds that are used for some of these calculations. So, what is MAGI? MAGI is modified adjusted gross income. It is used to calculate eligibility for tax benefits, credits, deductions, and some of the government programs. It is based on your adjusted gross income, or AGI as it's often called, and this is found on the first page of your 1040 form. It's very easy to see on there. You see a line that says adjusted gross income. So you're using that as a starting point. And for a lot of people, it's not a real meaningful change, or maybe even any change at all from your adjusted gross income to MAGI. It could be the same number, but a common MAGI adjustment might be adding back in federally tax exempt interest income, for example, or making some sort of adjustment for foreign income. So a key point that we want to make is that the MAGI is not a standard calculation. It really depends on what you're using that particular MAGI for, on what the change is. So if you're really needing to look at a MAGI calculation, again, you start with your adjusted gross income, and then it's pretty easy to find, or we can always be available for questions to look to see if there's a meaningful change to adjusted gross income for that particular calculation. Examples of what MAGI affects would be, or affects the calculation, Social Security taxation, itemized deduction threshold, child tax credit, premium tax credit for people that are on marketplace health insurance, determining how much of the marketplace premium you would get as a credit or have to possibly pay back, IRA deductibility, Roth eligibility, and IRMA, which is the adjustment that may be made for Medicare premiums based on income. So we wanted to this is also a little bit of a step back. Before we jump into the OB3 changes, we thought it would be helpful to go over what was put in place with the 2017 Tax Cuts and Jobs Act. And that is a mouthful. So just like we're saying OB3, we're going to say TCJA when we're talking about this 2017 Act. Prior to TCJA, the standard deduction was much lower. There were personal exemptions and many more people itemized. So that was up through the 2017 tax year. That was not only because the standard deduction was lower, but also because there were just more opportunities to itemize, including the 2% miscellaneous deductions category that completely went away with the 2017 TCJA changes. So with this shift starting in the 2018 tax year, we saw much less itemizing and much more taking the standard deduction, especially for married couples filing jointly and those over the age of 65. So let's do a quick refresher at what we've been able to itemize for the past 7 or 8 years since the 2017 Act passed. And then we're going to look at the impact of OB3 on these deductions. These deductions are all reported on Schedule A of your personal tax return if you are itemizing. If you take standard deduction, no Schedule A is needed. And typically you are taking whichever is most beneficial, standard or itemizing, but you cannot do both. So for itemizing, we have medical expenses, and they have a threshold of you can only deduct what is over 7.5% of your AGI, adjusted gross income. So for example, if you have $100,000 of adjusted gross income, you can't start itemizing your qualified medical deductions until that floor of $7,500 is reached with deductions. And only then can you start counting towards the itemization. Next up, we have state and local taxes, which can include state income taxes. So we're presenting from North Carolina. We have a lot of clients in North Carolina, so this would include your North Carolina income taxes. And also property taxes. It could be on your personal residence, any additional vacation properties that you may have, and also vehicle taxes, other taxes like that. So a lot of times these are called SALT taxes, state and local taxes. That's what that stands for. Under TCJA, these have been capped at a total of $10,000 per return if you were single or married filing jointly. Now, this is huge because, in my opinion, this was one of the biggest limits for itemizing, especially for married couples, because they had that $10,000 threshold as well. If you were a high income earner or you hit or had high property taxes or both, that could potentially be deducted. Once you hit that $10,000 mark, it didn't matter. You could no longer deduct towards your itemizing. So we'll be looking at the limits on standard deduction, and you can see how, especially again, for people that are married filing jointly or those over the age of 65, if they didn't have a lot of other deductions, they're hitting that SALT limit, and it really was limiting their overall ability to itemize in many cases. Next up, mortgage interest was under TCJA made deductible on mortgages up to $750,000, which included home equity interest only if used for home purposes. This was actually a decrease from the $1 million limit prior to TCJA with an additional $100,000 for a home equity debt. So you could, before TCJA, deduct up to $1.1 million potentially in mortgage and home equity debt, with fewer limitations on the home equity interest. So next we have charitable donations. These can include cash, non-cash, appreciated securities, and collectibles that you could donate to qualified charitable organizations. TCJA increased the cash donation limit to 60% of your adjusted gross income. Under TCJA, you could still deduct casualty and theft losses related to federally declared disasters. This is important to highlight since so many in our area had losses due to Hurricane Helene in 2024. And also gambling losses have still been deductible, but there were some specific rules around those. One of the biggest changes with TCJA was eliminating the 2% miscellaneous deduction category, which was very impactful to some taxpayers if they were investors, since it included investment advisory fees. So bottom line, we've been in a period since the 2018 tax year under TCJA where fewer people itemized, both because there were fewer itemizing options and also because the standard deduction was so much larger. And this was all scheduled to revert back to pre-TCJA levels at the end of 2025 before OB3 came along. So now that we've had our crash course on what the landscape has been under TCJA, and then it was scheduled to revert back to pre-TCJA levels at the end of this year, 2025, let's dive into some of the modifications that OB3 is bringing to some of the itemized deductions. So something that's brand new, it's not going to affect most taxpayers, but it is new, so we wanted to certainly give it a mention, is that top income earners, those in the 37% bracket, will be limited on their total itemized deductions. So this is assuming that you are able to itemize. This overall limitation is being referred to as the 2 of 37 rule, and it effectively limits the value of the total itemized deductions available to those in the 37% highest tax bracket to just 35 cents on the dollar. So 35% is the next bracket down from 37. So you're getting that 37% deduction even if you're at 37%. So for example, a married couple in the 37% tax bracket that claimed $100,000 in itemized deductions would see their deductions capped at $35,000 instead of $37,000. Now you can see here on this slide that we are talking pretty significant income levels. This is taxable income, so this isn't even adjusted gross income. This is an even lower threshold with taxable income, but still we're seeing for single that these are people that have taxable income of 640,000, 601 and above, and then for our married filing jointly, it's starting at 768,701. All right. So we talked about our SALT cap, our state and local taxes. Um, this is starting our review of the itemized deduction modifications under OB3. The SALT cap has been made permanent, but, and this is a very significant but for some people, starting with the 2025 tax year, so that is this year, it is scheduled to jump significantly from the $10,000 limit up to $40,000 for both single and married filing jointly filers. There's still a limit of $20,000 for married filing separate. The limit before, instead of $10,000, was $5,000 for those folks. So for taxpayers who pay significant state income taxes and or have high property taxes, this may be a game changer for itemizing. Now this SALT deduction is scheduled to increase by 1% each year through 2029. And then the deduction is currently scheduled to revert back to the pre-OB3 SALT limits in 2030. So we will go on the assumption that it's going to revert back to 2030. I think that there have been a lot of pushback to the $10,000 limit. So this increase in the limit was in response to that, especially in states that have high state income taxes and or property taxes. So this may be a little bit of a dipping the toe in the water, seeing how this is received, how it is impacting the numbers for what's coming in for taxes and whether taxpayers are able to itemize more. So it's a little bit of a to be continued to see if we will revert back in 2030 or if there will be further law changes moving forward. You'll also see on the right-hand side of this slide that there is a phase down. It is a pretty high level and it's a modified adjusted gross income phase down that starts at $500,000 of MAGI. And then it phases down from a $40,000 deduction down to if you have $600,000 of the MAGI, then you're reverting back to that $10,000 limit. That is also an increasing limit, 1% of that MAGI level, and then is scheduled to revert back in 2030. Next up, we have our mortgage interest. So OB3 made the $750,000 limit permanent starting in 2025. This is interesting to me because there's no inflation adjustment for this 750,000. And we all know that even since TCJA, home prices have continued to rise, and therefore, along with it, for many, their mortgages for people that are getting new mortgages. So it's interesting that that limit is still the same, and we may have some creep up where this limit is impacting more people as a threshold, which can make the calculation for the mortgage interest deduction a little bit more complicated and also just limit in total the amount of that deduction. Keep in mind that if you're on a mortgage that started before December 16th, 2017, the limits beforehand were grandfathered in. So that would be $1 million for the mortgages. Moving forward under OB3 at the bottom of the slide, you can see that starting in 2026 and beyond, the PMI, private mortgage interest, private mortgage insurance deduction is reinstated. Okay, so we'll go on to charitable donations. Prior to TCJA, more taxpayers were able to donate through itemizing simply because there was, the standard deduction was lower, more people were itemizing. And remember, these are to qualified charitable organizations. Itemizing was more in reach overall to the average taxpayer. It's estimated that TCJA reduced the number of households that were claiming an itemized deduction for their charitable donations from roughly 37 million in 2017 to 16 million in 2024. In 2018. In 2024, only about 10% of households were able to itemize deductions on their charitable gifts. Some of you may be familiar with the qualified charitable distributions, also known as QCDs, that you can make out of your IRAs starting at age 70 and a half. And we just want to point out that this is a completely different type of deduction. This is an itemized deduction. QCDs are done in a different part of the tax return and are limited to those who can make those out of their IRA starting at 70 and a half. So this is different. For 2025, OB3 makes the 60% cash contribution AGI limit permanent, but also OB3 gives us a new floor on deductions for itemizers starting in 2026. Donations will be deductible only after exceeding 0.5% of AGI. So to use a real world example, if a couple with an AGI if a couple has an AGI of $200,000, they would have that floor in place and they would only be able to start considering for itemizing after the floor of $1,000. So that's similar to the floor that we see with our medical deductions. Now we have something new and exciting starting in 2026, which will be that if you are taking a standard deduction, that you can, instead of itemizing, that you can deduct up to $1,000 for a single taxpayer or $2,000 for married filing jointly, that can be taken on cash gifts, just cash, directly made to public charities. And you can do this at all ages, and there's no income limit. So hopefully this increase will allow more people to get some benefit for their charitable giving and maybe even increase what we see with charitable giving overall. So we're going to talk a little bit about the Affordable Care Act premium tax credit. As a refresher, the Affordable Care Act, or as it's commonly known, Obamacare, was signed into law in 2010, marking a significant overhaul to the U.S. healthcare system. In the years leading up to ACA, about 14 to 16% of people in the U.S. were uninsured across all ages before age 65. In 2023, the uninsured rate with marketplace options and Obamacare in place dropped to a record 7.7%. ACA recreated these regulated health insurance exchanges or markets known as marketplaces that offer financial assistance to those without traditional insurance. Marketplace enrollees can receive a subsidy on their health insurance premiums if they meet certain criteria, including having a household income between 100 and 400% of the federal poverty line. This could come through a reduction of premiums monthly, which is then reconciled annually on the tax return through Form 8962 for the premium tax credit. Depending on your actual income, you could get additional tax credit on your tax return or have to pay back some of this subsidy through this Form 8962 reconciliation. So for those of you on Marketplace, that's why if you work with us or whoever your tax preparer is, we're always asking you for that Form 1095A. That's the form that we use to do this reconciliation. And if you're on Marketplace, it is required that you submit your Form 1095 on the tax return each year. Now, starting in 2021, there was some premium tax credit availability to those on Marketplace coverage above the 400% federal poverty line. Health insurance continues to be very expensive, and millions of Americans have been taking advantage of this tax credit, especially this additional tax credit, than would have been able to otherwise do so. So as of today, the government shutdown is over. We just recently went through all that. And there are a lot of the uncertainty and that ACA, the additional tax credit is set to expire at the end of the year. That was part of the discussion around the government shutdown. So even though shutdown is over, the fate of ACA and premium tax credits remains somewhat uncertain. But right now, without any action from the government to address future health care, these tax credits are set to expire at the end of 2025. The research that we were looking at shows that uninsured taxpayers are expected to increase, similar to prior ACA, with roughly 4 million additional taxpayers expected to lose or forego coverage in 2026. Now that there's going to be this cliff that starts with at the 400% poverty level. Other things to be aware of if you're on Marketplace or if you're looking at Marketplace coverage is that the plans no longer auto-renew, so you must manually enroll and update information, including your income, each year or risk losing coverage. All right, I'm going to pass it on to Nora now. Oh, I'm sorry, we have one more slide here. Our estate and gift tax. This is another change that was made permanent with OB3. There was a lot of talk. Now, again, this is something that certainly doesn't affect most taxpayers, the average taxpayer, but it is important to those who it is impacting that under OB3, the permanent lifetime exemption for the coupled gift and estate tax exemption is set at a baseline starting at $15 million per individual, and that will be adjusted annually for inflation. We'll also do just a little reminder here on gifting that the annual gifting exclusion is $19,000 for both 2025 and 2026. All right, now I'm going to pass it over to Nora. So Nora, you take it away.
Thank you, Ashley. All right, so Ashley has mentioned a few OB3 highlights and the impact of them. So let's focus our attention now just on the 2025 tax year and what aspects of TCJA or OB3 are good to keep in mind as you are getting things ready for the end of the tax year and getting things ready just for tax time. And as a side note, during the 2025 tax year in review portion of our discussion, so these slides right here that are going to be coming up, you'll see in the upper right-hand corner of your screen an OB3 Me impact bubble. And these bubbles are just additional notes of interest as they relate to the topics mentioned on this slide. So we'll briefly touch on increases in certain areas for the 2025 tax year. We've already talked a little bit about the concept and purpose of the standard deduction and how it differs from itemizing. We've also seen increases in tax brackets and retirement plans due to inflation. Now, there have been some changes to certain areas like self-employment reporting, AMT thresholds, and the new four individual deductions from OB3, and just some comments on certain credits. And then lastly, we need to talk about how these changes and really still, the shutdown in itself, thankfully that's over, and how it and these changes, how they've affected our best friend, the IRS. Absolutely, this year has been a catalyst of change for the agency. Its daily operations, the amount of people available to help taxpayers and or tax professionals. So we just want to shine a light on IRS updates that may impact you and your tax advisor directly. Alrighty, so first up are tax brackets. So a little background context regarding tax brackets and why income thresholds may shift from year to year. On an annual basis, the IRS adjusts certain tax provisions for inflation to help with something called bracket creep. And as we see in our OB3 bubble, the tax rates set by TCJA have been made permanent. These rates were set to expire at the end of 2025. And so this is a positive for taxpayers as tax rates prior to TCJA were higher. Now, on our slide, we've listed four common brackets, the bracket rates, and their corresponding taxable income threshold for 2025. So again, these threshold ranges, they will continue to shift every year, but the tax rates themselves, those will remain the same. It's also important to keep in mind that because the federal tax rates are marginal, you only pay taxes at a particular percentage within that particular bracket. So using our table here, for example, while a married filing joint couple may be in the 24% tax bracket, only the dollars over 206,700 and below 394, well, actually 601, yeah, those are taxed at that rate. They're still going to get to take advantage of those lower brackets as well. Now, something just for our North Carolina individual filers, these numbers are for you. NC income tax rates continue to drop. We can see just from 10 years ago, the tax rate was 5.75 in 2015. Now we're looking at 4.25 for 2025 and even lower, 3.99 for the 2026 tax year. Now, before 2015, NC was also on a marginal income tax rate system, like the federal, with brackets as high as 7.75%. So this has been a real shift towards lower income taxes for North Carolina residents as they continue to decrease. So Ashley previously mentioned about the standard deduction, and it is also impacted by inflation. So prior to the passing of OB3, taxpayers were already going to see a bump in the standard deduction. However, OB3 took that bump and increased it even more. So while a single filer was originally going to see their 2025 standard deduction increase to $15,000, OB3 raised it another another 750. So now up to 15,750. So we can see some additional benefit there. One group of taxpayers in particular, though, they can benefit quite a bit from OB3 and as it relates to their standard deduction, and that group is seniors. So let's talk about how they benefit with the passing of this new law. On top of the standard deduction, qualifying seniors can receive an additional benefit, but it does vary depending on filing status. If you're age 65 on or before the last day of the 2025 taxable year, then you can receive either $2,000 or $1,600 in additional deduction. If you are blind and meet the age requirement, then your additional deduction doubles. OB3 introduced an extra bonus deduction, which is an additional $6,000 for single filers who qualify, and $12,000 if filing jointly and both spouses qualify. The bonus deduction can be used by those who take standard or itemize. Now, we do need to keep in mind that this extra deduction is temporary, effective only from 2025 through 2028. It's also subject to income limits. As we see on the table, once Magi hits 75,000 for single filers, the 6,000 is going to start to phase out. And similarly for married filing joint couples, the $12,000 bonus deduction will start to phase out once Magi hits 150K. And one other thing that I thought was interesting during my research on the standard deduction and its impact on this group, on seniors, is that the new OB3 bonus deduction aims to decrease the taxable income of a senior taxpayer, which in turn can then decrease the taxable portion of their Social Security benefits. Now, we could easily spend a full day talking about the intricacies of Social Security and the tax strategies around it, but just know that there are currently no changes under OB3 to the percentages used to calculate the amount of Social Security subject to tax. All right, so now let's shift over to two primary retirement plans, traditional versus Roth. Now, both plans are a powerful tool for saving for the future, offering tax advantages that can grow your money over time. Now, while both traditional and Roth IRAs are designed to help you save for retirement, they do differ in how and when you get the tax advantages. So let's compare the two plans on our slide. So on the left-hand side, we have traditional IRAs. So with these, you fund your account with pre-tax dollars. No tax is incurred when contributing these funds. The funds will grow tax deferred until you are ready to take distributions. Now, note, if you take your distributions prior to 59 and a half years old, you will incur a penalty unless there is an exception involved. Also know that with this type of IRA, you're required to start taking something called required minimum distributions. We also call them RMDs, starting when you're 73 years old. And these distributions will be taxed as ordinary income. Now, in contrast, Roth IRAs on the right-hand side, these are where you contribute after tax dollars. So the tax is incurred when you contribute. The funds grow tax-free, and Roth IRAs are not subject to RMDs. Similar to traditional IRAs, if you do distribute funds out of the Roth before you are 59 and a half years old, you could be hit with a penalty. And also remember that you need to have held that Roth for at least 5 years. And for both retirement plans, you need earned income to fund. Those annual contribution limits vary. They do differ depending on your type of retirement plan. For traditional or Roth for 2025, you can contribute 7,000 or 8,000 depending on your age. If you have a 401k, your annual contribution limits are also dependent on your age. For instance, if you are between that special age bracket, 60 through 63 in 2025, you can contribute up to 34,750, which is the base amount plus an additional 11,250 just for those taxpayers who fall in that age range. Now, while we don't have this on the slide, starting in 2026, high income earners age 50 and older who make catch-up contributions to an employer-sponsored plan will need to contribute on a Roth basis. So you would pay the tax now, but enjoy tax-free growth in retirement. This new rule is a part of the Secure 2.0 Act. And also looking ahead to 2026, due to inflation, annual contribution limits will increase for the retirement plans listed. We'll also see in 2026 our first annual cost of living adjustment for those age 65 and older. All right, next up are capital gains. Now, let's first just mention that capital assets include investments like stocks, bonds, cryptocurrency. These can also be personal and tangible items like cars and boats. A capital gain occurs when the sale of a capital asset is more than its original value. Now, on the flip side, a capital loss is the opposite. The sale of the capital asset is less than its original value. And from that sale and potential profit, you can have a gain. And the type of gain and resulting type of tax rate can be classified as a short-term capital gain, which is taxed at ordinary tax rates, or can be classified as a long-term capital gain, which has three different tax rates. The table on this slide provides a snapshot of the long-term capital gain tax rates. And just know that OB3, it preserves the existing capital gains tax structure, as well as keeping the long-term rates the same. And finally, a reminder about net investment income tax. We also call this the NIT. This is an additional 3.8 tax on top of capital gains tax once income hits above a specific filing threshold. Okay, now related to capital assets is a new form that brokers will be issuing if you invest in any digital assets. And these are assets like cryptocurrency. And digital assets are considered property, not currency, though they have equivalent value in real currency or act as a substitute. So this new form, it's called the 1099-DA for digital assets, and it will be issued starting with the 2025 tax year. So if you have any digital asset investments and there are transactions, then you may receive this form early next year. Now, most of the forms will not include a cost basis for your digital asset investments. You, the taxpayer, you are required to track the bases, or all of your sales may be reported as gains. The IRS does want to know if you've had any digital asset transactions for the taxable year. So there is a question on the 1040 related to digital assets. So keep aware that if that question applies to you, make sure you answer the question accordingly. Now let's switch gears and talk about how people make money. In this economy and with inflation, taxpayers are looking for additional sources of income to help supplement a full-time or a part-time, standard W-2 job. It's not just the standard 9 to 5 work week anymore. Taxpayers want flexibility and control. So let's say you make hats. I love this, love it, hats. You just love to make them. Well, if you sell these hats rather than giving them away for free, then you could potentially have self-employment income. So you'll need to determine what your intent is with what you're selling or service you're providing. Is it a full-time, a side hustle, or is it just simply a hobby? If you determine that your hat making business falls under self-employment, then any income over $400 in a taxable year must be reported on your return on Schedule C. The good thing by setting up this Schedule C is that you can deduct certain business expenses like mileage, meals, and home office expenses. You can deduct health insurance expenses up to net income. You can also take depreciation on assets. And for those self-employed or have investments, OB3 kept the QBI deduction of 20% permanent. So you can still take advantage of that deduction if you qualify. Now, some aspects to keep in mind, though, is you need to keep your business activity separate from personal. That means separate financials and separate bank accounts. And also be aware that if your hat making business is not doing well and is reporting a loss for some years, this means the losses are reducing your taxable income, and the IRS is going to notice. They're going to notice the abundance of those losses and they may question you. So ultimately, just talk with your tax advisor, whether it's us or someone else, to see if you fall under self-employment or if it's just simply a hobby. The IRS says that if your business generates profit in 3 out of 5 consecutive years, then that is presumed a business. Otherwise, you may just have a hobby and you would report those proceeds differently on your return. If you determine, with the help of your tax advisor, if needed, that your business is a sole proprietorship, or even if you receive money from a side gig, you may come across these two forms. We have here on the top the 1099 NEC, which reports non-employee compensation, and we have the 1099 MISC, which reports miscellaneous payments to individuals. Now, with OB3, it increased the reporting thresholds for those forms starting with the 2026 tax year. So going forward, the forms are required if payments received or issued are $2,000 or more. That is certainly a bump from the current threshold of $600. And also going forward, these thresholds will be indexed for inflation. And lastly, just a couple friendly reminders. First, if you receive self-employment and or side gig income above $400 and you did not receive a form from the payer, you are still required to include that income on your tax return. And second, if you have someone that you need to file one of these forms for, please remember to file the forms on time. Another form you might see if you're self-employed, or even if you have a side gig of, say, like mowing lawns and using Venmo to bill the homeowners, there is an informational form called the 1099-K. This form reports various credit, debit, and gift card transactions, as well as third-party payments from a processor like Amazon, Venmo, or PayPal. These forms report all income received from that processor. It does not distinguish between taxable and non-taxable payments. So if you happen to receive one of these forms, you may need to separate out any non-taxable transactions that don't need to be reported on your return. Now, if you do receive this form and there are payments that need to be reported, work with your tax advisor to know which transactions belong on a Schedule C or a Schedule D, because they are treated differently on these two forms. Now, under OB3, the reporting threshold for processors to issue this form, this 1099-K, is that the payee must have received at least $20,000 in gross payments, as well as had 200 plus transactions. So many taxpayers may not hit that reporting threshold and receive a 1099-K, but income received from selling goods or providing services do still need to be reviewed and reported accordingly. All right, so shifting to AMT. So we're not going to go too much into detail on this slide, but let's just talk about some things to take away. So AMT is one of the two methods to determine the tax liability on your tax return. Once your return is complete, the tax liability is compared under the regular tax system to the AMT liability, and you pay the higher of the two methods. This is a way to ensure that high income households pay their fair share of taxes because AMT removes certain adjustments and deductions. TCJA, it increased the AMT exemption as well as the phase out level, thus reducing the number of households exposed to AMT. I mean, the exemption amount for 2025 is over 600,000 for single filers and over 1 million for married filing joint. So depending on your filing status, you would have to earn those amounts to feel the impact from AMT. With OB3, it makes the higher exemption permanent, but realize that it will reduce twice as fast once income exceeds the earnings threshold. All right, and lastly, under our changes portion of the 2025 tax year in review, it's the topic of individual deductions and credits. So starting in 2025, there are 4 new temporary tax deductions available for individuals. These are from the onset of OB3. Eligible taxpayers will use this new form called Schedule 1A. It's called Additional Deductions to calculate MAGI and to claim tax breaks for which they qualify. All 4 new deductions are below the line. Now, one temporary deduction in particular is for new cars purchased between 2025 and 2028. If you take out a loan on the new car, the loan must originate after December 31st, 2025. The interest that is paid on the loan can be deducted up to $10,000 annually, and this deduction is available to both itemizers and non-itemizers. Now, a popular tax credit for dependents is the child tax credit. Under OB3, a social security number is now required for the dependent and one of the parents or guardians to be able to claim this credit. The maximum credit increased to $2,200 per child. There is a refundable portion of the credit up to $1,700 per child. And just keep in mind that the qualifying child must be age 16 or younger by year end 2025. And finally, and we may already be aware of this, is that certain clean energy credits have either been or are going to be terminated. One such credit that has been eliminated is the electric vehicle credit. A couple other credits expire at the end of 2025 that are energy related for personal homes. So just take action now if you want to take advantage of either of these energy credits on your 2025 return. Finally, it is notable to mention some IRS updates for 2025. But before we jump into those updates, there is a draft of the new 1040 available online if you would like to take a look. So that's just to give you something to look at until the new filing season. This form will begin with the 2025 filing season to incorporate OB3 changes effective starting this year, like those four new individual deductions that we mentioned just a little bit of just a moment ago, and how they flow in from that new Schedule 1A form. So if you want to take a moment, pull that up online just so you can become a little bit familiar and just remember it is a draft at this time. So now on to updates. Since January of this year, there has been an overall 25% workforce shrinkage within the IRS. Now, they have business units within the IRS, and three of them have experienced the biggest impact. Those are taxpayer services, small business and self employed, and services for tax exempt and government entities. And due to this shortage, we can reasonably expect to see IRS processing delays of the 2025 tax returns. We can also see limited assistance or prolonged wait times in reaching the IRS in person or telephone, and also with resolving tax return errors. Another impact to be aware of is an increase in tax related fraud, since there will be fewer workers to catch and prevent fraud before a refund is paid. Now, to mitigate this increase in fraud and to prove efficiency and lower costs, hopefully, the Treasury Department has transitioned all federal disbursements, including tax refunds, to electronic payments. This transition is as of the end of September 2025. And on a related note, starting with the 2025 tax return, you must provide direct deposit details unless you qualify for an exemption, of which there are few. Okay. Now, some tips for your 2025 tax return filing. So, first up and most important is to e-file, then e-file, and then also e-file. It's the quickest and most secure way to file your taxes. And if the IRS has any issues with your file return, then you should know faster. So just e-file if you can. Also, 2025 taxes are due on Wednesday, April 15th of 2026. That's even if you file an extension. There's almost no extension to paying your tax liability, just an extension to file. Make any payments electronically and verify that they process. Pay attention to any changes in income from the prior year and share those changes with your tax advisor. The sooner the better. If you have income but you don't have any withholding, consider making estimated tax payments to avoid or reduce underpayment penalties. And if you have an error on a prior year return, consider amending it. And if you receive a tax notice, verify that notice and the assessed amount that's listed on the notice that they're correct. You may also end up needing a tax professional to assist with that notice, so get in touch with them for any help. And finally, as of early November 2025, the IRS has shut down its direct file free tax filing program with no plans to reinstate. The termination affects filers in 25 states who used direct file for federal portion of their individual returns, and that does include our state of North Carolina. All right, so now passing back to Ashley.
All right, so for our final portion, we're really trying to keep the presentation to an hour. We don't have questions since it's just Nora and us, so we've got a little more time. I want to highlight that a big part of what we do here at GenCrest is tax planning that goes along with our tax return preparation. So we only do tax work for our existing clients. We don't do any outside tax services. And what we're really trying to do is I always look at the tax return as our reporting device where we're saying, here's everything that we did for the past year, but also at that same time and leading up to it, oftentimes we have a multi-year strategy. We're looking at different types of tax strategies that we can use. These may be to lower income taxes now. They may be to lower income taxes later. There may be some, shifting in what we call buckets, different types of assets and investments and how those are taxed. We may be shifting those to be more maximized over time. It may be an estate planning strategy. It may be a healthcare strategy for someone who is, they're having major health issues later in their life, needing, assisted living or something like that. So there's all kinds of reasons that we have different tax strategies, and we really work carefully with our clients to do customized strategies. So what we're going to talk about here is going to be, again, like Nora said at the beginning of the presentation, very high level, very broad, and these are not specific recommendations. They are just tactics that we look at and customize our recommendations based on what's appropriate for a particular individual and their tax situation. So we'll be looking at HSAs, Roth IRA conversions, minimizing RMDs. We touched on RMDs a little bit. Those are from your IRA, and gifting. So I'm just going to touch on these at a pretty high level. HSAs. So as a reminder, you can fund an HSA as long as you have a high deductible health plan. That means more than just a high deductible on your insurance. It's actually a specific kind of insurance called HDHP. It usually does not have copays for most office visits that you would see with other types of plans. It'll oftentimes have HSA in the title of the plan. So if you have an HSA compliant plan, an HDHP, then you can contribute to HSAs. HSAs are very beneficial because unlike when we went over the IRAs and the Roth IRAs earlier, those types of retirement plans where you're either paying tax later with the traditional pre-tax IRAs, or you're paying tax on the front end and it goes tax-free with our Roth. With our HSAs, we're getting the best of both worlds, although in smaller dollar amounts. You contribute pre-tax, it grows tax deferred. Those dollars can be invested and then they can be used, taken out tax-free as long as they're used for qualified medical expenses. There's a list of qualified medical expenses that you can get from the IRS. It's on a certain form and it goes into it, but there are a lot of things that are on that list. It's important that you check, but it can't even include paying for Medicare supplements or long-term care insurance tax-free. So there's a lot of planning opportunity, especially when you think that HSAs are not use it or lose it like flexible savings accounts. You can roll these over year after year. You can grow the balances and even invest them. So there's a lot of power in the HSAs for when they're appropriate and you have the ability to fund. Looking at this, the funding limits for this year: single $4,300, family $8,550, and then there's a catch-up contribution. Keep in mind that's a 55 plus catch-up, unlike our retirement plans, which our catch-up starts at age 50. So it's $1,000 catch-up. We want to remind you that it's important that you track your contributions, how much you're contributing in a particular year. You can contribute up until April 15th of the next year. So you want to make sure that you know what year you're contributing for. And also it's very important that you pick up the distributions on your tax return. There's a certain form for that. So if you take money out of an HSA, it is not required by the IRS and they will not remind you. We will hopefully remind you if we see it, if we're aware that clients have HSAs, but we do want to report those distributions along with the offset for any qualified medical expenses that the distributions were used for, so that's not picked up as taxable income on your tax return. Looking at RMDs, we could do a presentation that would go all day on RMDs. So again, we're just barely scratching the surface, but as a reminder, RMDs, required minimum distributions, are annual mandatory distributions from your IRA account. These are your pre-tax IRAs subject to ordinary income tax. So if you're at a certain tax rate and you have to start taking RMDs, this is why you hear people say, oh, RMDs, it's going to be on top of that. So for some people, it can increase their income. If they have to start taking RMDs and these IRAs have grown and grown and grown for years, and you have to start taking these RMDs, it can push you into higher tax brackets and also create additional tax on Social Security, and investment income, for example. RMDs under OB3 started age 73. So a while back, you had to start taking your RMDs at age 70 and a half. Then it was 72. Now it's 73, and it's eventually scheduled to go to age 75. So the age has continued to creep up when you have to start RMDs. It's calculated annually every year based on the IRA value from the last day of the prior year and your current age. So we never know what your RMD is going to be until January 1st of that year, but then we know January 1st. So you can take it at any point in the year. You want to keep in mind that there is a penalty for not taking RMDs, although there is some opportunity for penalty forgiveness. So that brings us to, now that we've done a refresher on RMDs, QCDs. This is where I mentioned this earlier. We talked about the itemizing. This is the QCDs, and that's where you make charitable donations directly from your IRA tax-free. Starting in 2025, to the excitement of tax preparers, including Nora and myself everywhere, they are finally, since QCDs started, going to have some sort of reporting on the 1099-R form for QCDs. Up until now, it was up to the taxpayer to provide the information to the taxpayer to provide their information to their preparer, if not self-prepared, that they had done QCDs. There was no tracking for it on the 1099-R, and my guess is that they sometimes fell through the cracks. So now we will hopefully have some reporting. Understandably, it's very important for you to double check your records and make sure that the reporting looks accurate. And also to remember, you could have QCDs coming from different IRA forms. You may want to consider Roth funding while you're other tips for minimizing your taxable RMDs. We talked earlier about Roth. That's where you put money in with after-tax dollars and you don't have the RMDs. So folks may want to consider Roth funding, especially if they can cover the taxes they're at lower income levels or younger ages where they really have opportunity for that Roth money to grow. And another tactic that we like to see is Roth conversions, which we're going to touch on next, in years when taxable income is low. So we'll go into Roth IRA conversions now. You want to keep in mind that in order to qualify for a tax-free withdrawal or earnings, the account must be in place for at least 5 years, and the distribution must take place after 59 and a half or due to death, disability, or first-time home purchases. Depending on state law, Roth IRA distributions could be subject to state tax. You can make tax-free distributions for qualified medical expenses. And we want to remind you that this is a great asset to pass on to heirs tax-free, although it is still subject to the 10-year beneficiary rules, just not taxed. Roth conversions, this is where you convert traditional IRA assets pre-tax to Roth IRA assets after tax and pay the tax now. Now, unlike on this last slide where we were talking about that you have to wait until age 59 and a half to take distributions from the growth in a Roth account, you can do a Roth conversion at any point. What you want to keep in mind here is that there used to be a rule where you could retroactively reverse the Roth conversion. That's no longer allowed. We can still see backdoor Roth conversions, which is where we convert after-tax dollars, after-tax IRA dollars to Roth. That's oftentimes used for people that are over the Roth funding limit, over the AGI funding limit. So there's a lot of opportunities for Roth. One thing that was mentioned on this last slide, excuse me, I think it is here. Sorry, it was under QCDs. Considering Roth conversions in years when taxable income is low. That really probably would have been better over here, but we'll talk about it now. That oftentimes when we're doing a Roth conversion strategy, we're doing it over a period of years. So we may take a year that someone has really low income. Maybe they've retired already and they're not taking their RMDs, so their working income has reduced. They have a year that they have really high charitable donations and or medical expenses, all kinds of reasons. We want to look strategically at those years as opportunities to convert to Roth. Another strategy is more of a drip strategy where you're not doing it all in one year, because remember, whenever you do a Roth conversion, that is raising your overall income. So you want to be mindful about how it may affect your premiums for marketplace health insurance or your IRMA for your Medicare premiums. Other factors on your tax return, including the NIT that Nora was talking about, how much of your Social Security may be taxed. All of these are considerations. So we tend to lean towards, if when appropriate for conversions, we're doing a strategy where those conversions are done over a period of time and strategically trying to utilize years when income is lower. We touched on the lifetime gift limit that has been made the lifetime estate limit, which is a really big, important change for those who it impacts under OB3 being made permanent. We want to talk about gifting as a strategy. That was touched on that slide as well. The 2025 annual gift tax exclusion amount is now $19,000. That is per donor, per donee. So, for example, parents can give a child and their child's in-law up to $76,000 in 2025 without having to file a gift tax return. Technically, you should file a gift tax return if you're doing gift splitting. So you do want to keep that in mind. So that's where it's good to, if you're doing any kind of gifts, we have a lot of clients that if they're even getting close to that gifting limit, they're reaching out to us to make sure that they're following the rules and determine if a gift tax return needs to be filed. You want to keep in mind that the recipients are not taxed on the received income, and that also it is that that you're just following all the rules for the tax return filing. Um, you want to get good professional advice if you're considering selling a home or other real estate in terms of if there's any discounting, and you need to consider fair market value for the gifts. This is really important, especially if you're transferring an asset over. So this would be for a non-cash gift. Could be stock, low cost basis stock. It could be real estate that the recipient, it could be a collectible, that the recipient of the gift uses your cost basis. Remember that step up in cost basis for a recipient is for inherited assets, not gifted assets. So occasionally we'll run into a situation where someone is much later in life. They maybe have low cost basis stock. And it may be something that we talk about as a strategy, with a reminder that you do get a step up in cost basis for inherited assets. If you have to report any gifting above the exclusion limit, and including, remember that would include gift splitting between spouses, that's reported on Form 709. And the reportable gifts reduce the lifetime gift exemption, which is integrated with the estate tax exemption. So our final tips as we're wrapping up here today, we say this all the time here at GenCrest. We're in court, we're doing tax strategy a lot of times in conjunction with investment strategy and or decisions that need to be made for other aspects of a client's life. So we really do try and say, be mindful of the tax impact of your decisions, not, and that things can affect each other. It can be a little bit of a domino effect sometimes with having a high tax event. But you don't want to just let the tax tail wag the dog. Strategize the decisions based on your whole financial picture, not just solely on the tax changes. Bunching. So we talked about these different itemized deductions. Bunching has been around. It's really been discussed a lot since TCJA. In my opinion, we have more opportunities than ever to bunch with OB3, especially with our changes to the SALT limitation. That's a big change. So you may want to consider looking at consolidating deductions. In a year, you could look at with charitable donations, doing things like funding a donor advised fund in a year that you have high medical expenses, or paying your property taxes all for 2 years in one year if you don't run that through escrow. Other things you remember, we just want to remind you with our financial planning and our tax hats on, review your current 401k or other type of retirement plan that you're participating in. It could be a set plan, a simple plan, and make sure that you are, if you want, if you're able to, that you're continuing to max out because those limits continue to go up. And the last thing is we talk a lot here about buckets. So you really want to think when you think of your investments, not just about the investment strategy, your risk tolerance, how much you have in equities versus first income, but you want to think about your tax buckets. We've talked today about IRAs, Roth IRAs, taxable accounts, how capital gains are taxed in a taxable account. So, we have these different buckets, our HSAs, and all these things work in conjunction. So it's important that you optimize your investments, not just in terms of risk tolerance and performance and what assets are made within a particular account, but how these accounts can work together for good tax planning today, tomorrow, and beyond. Getting back to our title. So we appreciate everyone that came to our presentation. And moving forward, listening to this presentation on recording as well. Nora and I are always happy to, have a discussion. If someone's interested in talking about GenCrest services, you can reach out to us just for some initial chatting on that. If you're a client and you have questions from the presentation, certainly reach out to us. That's part of what we do. So we thank you so much for being here today. And thank you, Nora, for being part of our team and co-presenting with me today.
Yeah, thanks, Ashley.
All right. Bye-bye.